Hey, Dan Passarelli here. Well, that was quite a day, wasn't it? The market ended up closing down about, let's see here, 4.3% for the SPY, which is a pretty big down day. And the reason for that, of course, is because the CPI number came out today and it's still hot. It was 8.3% over the last 12 months, not seasonally adjusted. And if we exclude food and energy, that's still 6.3%. And it's just too much. And there's a lot of folks who are very concerned that the Fed is going to have to raise interest rates even more aggressively. Now, if we look online, the CME publishes a tool which they just simply call the Fed tool. You can Google it and it's freely available. And basically, what this does is it uses the federal funds futures contract that's traded at the CME group to figure out what the market, based on the prices of those contracts, what the market is pricing in as a likelihood for the target rates after the next announcement. And the Federal Reserve meets next week. The current target rate is 225 to 250 basis points. This tool factors in a 68% of a 75 basis point hike and a 32% chance of a 100 basis point hike. A 0% chance of anything else. So it's really looking very, very likely that as we keep getting worse and worse data, we had really good jobs number the last time we looked at it, which you would think is good news, but with the specter of the Fed having to raise rates, and with hot inflation just staying up there, there's well, you don't need me to tell you, if you've been reading the news, that there's a great deal of concern that the Fed is not going to be able to end inflation without causing a recession. It's starting to look that way to a lot of people. So that's where we are. That's why the market is down so much. September, of course, happens to be the worst month historically since like 1945 or something for the stock market. There's only 2 months, September and I believe February is the other one, that actually shows a negative return historically. And September is the worst of those two. So I think we could be in for quite a bit of a wild ride here. That said, we're going to be looking towards the PPI number tomorrow. We're going to be looking to see if the market follows through tomorrow. We went decidedly below the 50-day moving average, and that is always a very dangerous spot to be. We've got the VIX having risen greatly, 3.28 on the day, up to 27.15. So there's a great deal of concern that we could see some follow through, especially if we break through that 390 level. I think we could definitely see some follow through happening here. So we're going to be watching PPI tomorrow, and we're going to be watching the technical levels. We're going to be watching the market action. And hopefully, if the market does head lower, hopefully we end up with a situation where it's sell the rumor, buy the news, and the damage will be done by the time the Fed makes their announcement next Wednesday. Hate to be the bearer of bad news, but I hope that helps. This is Dan Passarelli, Trade Smart.